If you're watching this, that means that you have real estate investment appetite. I think when I first got started in real estate, my biggest goal has always been to extract as much possible juice as I can out of a deal. And what that means is the metric that I'm dying on, the hill that I'm dying on, is cash on cash return. The less money that I inject into a deal means the higher my cash on cash return goes. Even if you are Jeff Bezos or Elon Musk or some other rich guy in your town, if you have to continue to inject your own money into deals, eventually you are going to run out of money. Period. Die. It's just inevitable. So what I tried to figure out was, how can I either negotiate with the seller to leave money in the deal? How can I partner with an LP to bring the money? How can I, as a general partner, as an investor, find ways to create an infinite return on my money? That's my main goal out of the gate. But let me show you an opportunity here that I did with another investor, a partner of mine, an LP. And here's a real world example of a property that I purchased with my partners. And at the very end of this, I'll show you how they decided to invest in this deal. And if they're on the same page, if you're on the same page as what we are, then you'll discover that there's only one way to invest your money and your capital in real estate opportunities. So check this out. This is a property in Trussville, Alabama, which is northeast Birmingham, 5508 East Cliff Industrial Boulevard. This was purchased in 2022, $700,000 and some change. Loan to value of 75%, meaning that we got a mortgage for $532,000 from a local bank, meaning we had to show up with $177,000 for the down payment. Now, there's a couple of ways you can do that, of course. If you watch any of my other stuff, essentially we have the seller leave money in the deal, or if you have other limited partners that have appetite to invest, they're the ones injecting that down payment. I'll just be the manager on the ground. 25-year amortization, 7.25% interest rate, $46,000 a year of debt service. We're bringing in almost $88,000 a year. We got taxes and insurance. It's not a triple net lease. So our net operating income on this building is $76,000 and change. But after we service debt, our net cash flow was just about $30,000. So let me explain to you the three options that people have and you'll have when you go and invest in your next project. You can do an all cash purchase, all cash. You can borrow money the same way that we did on this deal. Or you can go a step further and do this infinite banking idea. So let me explain all three. Again, very simply, on the cash deal, you've heard of it before on the Bigger Pockets forums. You buy something for $700,000. You write a check for $700,000. Then you bring home $76,000 a year of net operating income. That's what you put in your pocket every single year, which is not a bad deal, right? You don't have any expenses. You don't have to pay anybody back. You're in control. But you also had to write a check for $700,000. So your return on investment in this case would be 10.8%, which is a double-digit rate of return, which is pretty strong, right? I mean, that's what we're all chasing. But we decided to go a second option and decided to borrow from a local bank. So similar terms, right? Purchase price the same, but we got a loan for the majority of the purchase. We injected $177,000 for the down payment. That operating income is the same. Our debt service, $46,000. Our net cash flow was the $30,800. How do we discover our return on investment? We divided our net cash flow or our net operating income by our injected equity. So $30,000 divided by $177,000 equals 17.4%, which is even stronger. So number one, you have to discover this. Is it better? Does your cash on cash return, if that's the metric and the hill that you're dying on, cash on cash return, is it better to use other people's money? You have to ask yourself that question. You use all cash, you got 10%. You use someone else's money, you got 17.5%. So immediately you recognize, myself, like I said, it's like I was a caveman discovering fire. I discovered if I use other people's money, my cash on cash return goes up. Voila. No wonder every one of their brothers borrowing money. No wonder. But then I got introduced to infinite banking, life insurance, whole life policy loans, and injecting that capital into deals. So let me show you on the third option what this looks like for my investors on this deal and their cash on cash return. Same purchase, same loan, same first position loan, but instead of my partners injecting $177,000 from just their checking account, instead they had enough capital built up in their whole life policies that they borrow it against it. They borrow it against the liquidity or the equity in their policy of $177,000 and some change. Now, You're probably thinking the same thing. Well, why would I pay interest on my own money? That doesn't make any sense. You're not paying interest on your own money. Let's say that they had $500,000 in cash value. They are compounding on that amount of money in their policy still, while they're charged by the insurance company 4% of interest. To have their 500 grand continue to compound, they're charged 4% on whatever they borrow. The spread or the delta in between there is massive. They're earning on this massive amount of money while they're paying this tiny amount of interest on whatever that they borrow against. So again, if you're willing to die on the hill of cash on cash, let's see what happens. Net operating income is the same. Debt service to the local bank is the same. And then our cost of capital, which is what it cost us to borrow the insurance company's money or to leave our 500 grand in our policy out there collecting the 4.5% guaranteed tax-free interest. So, which I'm not even putting on here. So that means we have a net cash flow, which is a lot less than the 76, which is less than the 30 of $23,700. But again, ask yourself this question. If you're dying on the hill of cash on cash, let's divide our net operating income, or this $23,700, by our cost of capital of $7,100. We now have a cash on cash return, if you want to call interest a cost, 333% of return. I like to go a step further and say we have an infinite return on cash because we're using none of our own money. We're using the bank's $532,000 and we're using the insurance company's $177,000. All the while our money is still in our policy, protected from taxes and protected from litigation. This is what I'm trying to discover and partner with people. Is once you discover the power of using not only the bank's money, but also the life insurance company's money and able to extract way more juice out of the same deal. These are the terms of the deal. This is how it went down. It's now up to you to decide what is the best financing option or purchasing option for you. If you're willing to die on the hill, like I said, of cash on cash return, there is no better option in the United States, in the world, than using life insurance policy loans, which, by the way, is an unstructured line of credit. Nobody ever tells you what you have to do with the money, your amortization, your payback schedule. They don't make you put your firstborn up for collateral. It's 100% in your control, and you're never told what to do with any of the cash flow. This money can go pay something else off. You can funnel it back into your policy. The insurance company does not care what you do with the money. It's all about control, and it's in yours. If you want to learn more about this idea and partnering with us with Infinite Banking and commercial real estate, give us a follow because it is all I talk about, and I hope I see you on the next deal with me. Talk to you then.